Hello again, everyone. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. This is our usual end of the month recap with Professor Vince Lanci. He's a professor at the University of Connecticut, and you also know him from Gold Fix, just great daily updates on all things gold and silver and other markets as well. And Professor, it's great to have you back. Without beating around the bush, let's get right into it. Um, the I think at our last interview a month ago, we both not kind of, but we both concluded that it looks like gold has probably put in a bottom in the market. We thought that this it's probably not going to go lower than this price. So I don't know. I mean, the strength this month, I mean, it's taken me a little by surprise. I got some numbers here. We're recording this. It's not quite the end of the trading day on Friday. Gold was up over 6% on the month, silver 11%, the miners, GDX almost 15, well, 14 something, GDXJ about 13%. So really strong
Wow.
month for precious metals. And I guess, I said without beating around the bush, and then I proceeded to beat around the bush for a minute. So my question is, what has driven this latest buying in the last 4 weeks or so? Gold going from the low 2600s up to almost 2840. What are the factors that have driven this latest spur of buying?
Just to before I answer that, two things. One, I remember that conversation last month. It was like we were both surprised that that's the low, but you said technically that's the low, and I said I can't believe it. Well, my comment was I couldn't believe the strength that we had after the election. I thought we'd have a bigger dip, and we did not. And so I guess the technicals made me change my tune. And while you were surprised, I think you saw that a little bit earlier than I did. Incidentally, thank you for the copy of the book, and we'll talk about your book hopefully during this conversation. But okay, why did it happen? I can give you a nice little progression. There were three buyers. The first buyer was China and other central banks. They said they were buyers. They bought it, and when they reported it in a report that I put out, uh, that Goldman tallied, they bought 55 tons. They bought in November, they bought in December. Now, the low that I think we had been discussing was the 100, one of the lows was a 100-day moving average. And that came in between 2580 and 2620 in spot, I believe. So call it 2600 back then, probably like almost a month or 2 months ago. And China said they bought in that month. So you know that China bought that price. Otherwise, it didn't, they may have bought higher too, but they didn't buy anything. Nobody bought lower than they did. Let's put it that way, because they have the deepest pockets. All right. So that was your first buyer. Your first buyer was your physical central bank Eastern bound buyer. And gold pulled away twice in this little like kind of like W thing or M thing on the daily chart, and then came back and touched the 100-day a couple more times and held again. So let's assume that's more central bank China style buying. And then it kind of just danced around with the 100-day for a little bit. And then it started to pull away. Now, the pulling away, the initial pulling away was, I believe, and it turns out to be right, at least if you look at the evidence, I believe it was people, someone starting to recognize that there was tariff risk. And we'll touch on I'm sure you'll want to talk about the tariffs specifically, but the tariff risk basically says the initial tariff risk, as Bob Coleman had also described, it was very simple. The initial tariff risk was this: if the United States tariffs a country, so let's say it's Canada, and you buy and you are a trader of Canadian silver, and you're short COMEX contracts hedging your physical because you intend to deliver your Canadian branded silver. Well, if the tariff comes in at 25%, then potentially you have to pay another 25% on top of the price on delivery. You would have to pay it, not the buyer. Okay, so that caused, and this is all reportedly, but it makes sense. It's how the physical market works. That caused people with that type of situation to say, well, I'm either going to get rid of that silver and find new silver. And some of them did that. And they started pulling silver and gold, but primarily silver at first, over from London because London's Switzerland, it's not tariffed, et cetera, et cetera. We can use it for anything. It's incredibly neutral. Um, so they started pulling metal over from Europe, from London. Or you could say, you know what? I'm going to just cover my short. I'm going to take my hedge off until I find the silver, right? So if you do that, you're going to just drive the price up, and you drive the price up a little bit. And then the third type is basically saying, I'm going to um, find the silver in the U.S. somehow, right? So, or you say, I'm going to pay the tariff. So those things started to trickle into the market, and silver and gold started to move higher, and that made sense. I'm not saying it was right, but it makes sense, and I believe Bob Coleman knows what he's talking about. And I've seen this before. I took delivery once or twice in silver just to play this game. Anyway, so now you have China, which is again buying it, and they're the floor. They're buying it at the 100-day moving average, simplified, and then the market just kind of moves sideways, and then all of a sudden it starts to work in an orderly fashion higher, and again, it's physical, but it's not central bank. They're out there saying, "I'm worried about the tariff risk." Okay, so that starts getting in the market, and the market starts pulling away from the 100-day moving average and it's consistent. And so when the market starts pulling away in consistent, methodical fashion, you eventually start attracting speculative players, people who, momentum players, right? Hedge funds, ETF buyers, and just your run of the mill CTA buying. And they start to pile in. And now you start to see what was a month of sideways with the slight drift higher becomes, what was it, 6% this month?
Yes,
Yeah,
it
so
was.
there you go. I
I
mean,
mean, about
that,
6.5%.
yeah, so I mean, there you go. So you end up getting that. So you have again, who bought? China and central banks provided the level that it would not go below. They raised the floor once again, right? And then you had tariff concerns, which becomes something completely different going into this weekend, raising the price again, trickling into the market, and then you have speculators, the funds, uh, getting in a big way. And in fact, uh, should we share that chart?
Yeah,
The
absolutely.
speculative funds?
You can pull that up.
Yeah, check this out. Check this out. Thank you. Check this out. You know, that's the cumulative flow to gold funds, and that includes, it's actually almost entirely ETFs, GLD and other ETFs. And I think, looking at it, say, through your eyes as a technician, I look at the market and I say, well, after the election, which was, November, whatever it was, November 5th or something like that, we should have really dove. And the reality of it is the open interest, the exit was significant, but it never broke that upward trend that started way back in June of 24. So now we're slightly above trend and we're moving, inexorably higher. ETF money is coming back. So this isn't even the speculative money, but it is American money that looks at things like dollar correlations, which again, it's even more surprising. The dollar has been strong. You know, uh, uh, your uncle or my great uncle, they don't buy when the dollar's strong, but they are this time. So that has been, I think, uh, a driver. You have the return of the U.S. investor on top of these tariff concerns, on top of China fundamental central bank buying. And those are the buyers that we've seen.
Uh, do do you also want to show? I know you have a couple other charts. Yeah, the gold inventories surging based on the tariff fears. Is that something we should show now, or should we get into that later?
Um, Wait, which chart are you referring to?
Gold inventories in New York surge under Trump tariff
Oh yeah,
fears. That's the title.
that's actually good. That's actually a good segue. We should do that now. Okay, so I mentioned the tariffs, right? And the basic reason that you as a as a person who deals in physical metal in the U.S. who handles Mexican or Canadian metal, you start to get worried about tariffs, and you may or may not do something. Now, I personally, as an aside, think this is not going to happen. But what I think doesn't matter. We're talking about Donald Trump. We're talking about a new world, and we're talking about a mercantilist mindset. So, getting my opinion out of the way, just stating it and getting it out of the way. Um, in addition to the seller, who's like, oh, I have to get this metal and swap it out for something else. You have all future metal. See, metal that the U.S. imports from Canada and Mexico. Let's pretend for a moment, that they're not going to sell to anyone else. And let's pretend for a moment that these tariffs do affect gold and silver. I don't think it'll affect gold. I do think it could affect silver. That's another conversation. But let's assume that it affects both of them. Well, that means gold and silver are 25% higher. I'm not saying it will happen, but their gold and silver is 25% higher. Now, does that mean world silver and gold go to it? No, what it means is everybody in Canada has got to sell their metal somewhere else, and that metal's got to be re-refined. So it's a home run for refiners. Very similar, and here's where we have been through this before. Not the tariff thing, the effect of it. And the effect now I think is a good time for a chart. The effect is this. You have, forgetting Asia, forgetting China, you have two places that have physical metal. You have London, the LBMA, and you have the COMEX. For the most part, the LBMA or London is seen as the physical hub of the world. And COMEX, while it can be, is set up to be just as important as the LBMA, is more of a future site. And it has metal, and you can get metal from it by any means you need to. Um, but it's not viewed that way. So it's almost like if there's metal in the COMEX, it's a parking spot. It's on its way somewhere else. And London is where you long-term park your metal. Now, during COVID, so what's happening now is the gold in London, forgetting the fact that we have a Canada Mexico thing. The gold in London is being pulled into the U.S. ostensibly because of tariff fears on Mexico and Canada, and they're real. But it's being pulled at a rate that's alarmingly high and does not, it more than covers the fear of Mexican and Canadian gold. It's over the top. Now, the question is, how over the top is it? Well, to give you an idea of how over the top it is, I think what I need to do is for a second look at this chart. This is the chart we need to look at. The last time the COMEX all of a sudden wanted all the gold it could get its hands on was during COVID. Now, the reason it wanted that gold as quickly as it did has never really been stated publicly. Now, I have a legitimate reason for them to want the gold, but in the end, the U.S., some believe, I partially believe this is true, wanted to repatriate as much of its gold as it needed because it was like the end of the world. We're worried about it wasn't about retail buying it, although that didn't help. It was about, hey, we might have to go on some sort of a gold standard, money might collapse. And so you see this incredibly steep incline in 2020 of gold inventories in New York surging uh, uh, on during COVID. Now, that's pretty steep. And believe me, it had a massive, massive effect on the marketplace in New York. Futures went into backwardation. It didn't make sense. Silver and gold in New York were trading at significantly higher prices than they were trading in London, even though it was the same exact metal. The reason for it was venue arbitrage. Their metal was in a different form than our metal. COVID shut down all the refiners. They couldn't resmelt it, et cetera, et cetera. But there was probably more going on than that. Now, fast forward to now, and you have this. And this is supposedly a reflection on, oh, I have some Mexican and I have some Canadian silver, and I need to swap it out. Well, you don't have this kind of an incline in 1 month of silver and gold here coming into the vaults because of, 5% of your vault inventory, having a stamp of a guy named Pedro or Jacques on the bar. That's just like not a reason to panic. You just basically say, okay, you talk to the government. Literally, what you would do is you'd say, whatever you do, President Trump, I'm going to need a month more time. And you get a carve out. That's what banks do. You get carve outs. So this should have not happened. Canada, it's my opinion. Canada and Mexico should not have caused that kind of an incline in gold and silver, but we got it. So why is all this gold being brought into the U.S. Above and beyond this tariff? Well, to be fair, the tariff might affect more than those two countries. The other comment is revealed from this chart. Now, this chart is similar in what it tells you to where the metal is going. Now, the chart basically oscillates until 2020 around zero. So it's basically a flat line. It's kind of a regression oscillator, overbought, oversold, right? And what it really reflects is above zero or some neutral number, metal is flowing into the US. And below zero, metal is flowing into London. So it really is a kind of a proxy for who wants the metal more. You want the metal, it's like you're robbing Peter to pay Paul, but you're doing it under the guise that, hey, no one's really going to take delivery of the metal. We could do this all day long, and then in 6 months, I'll ship it back to you. Well, COVID happens, and then you see this incredibly large volatility. Now, where we want the metal, it went to London, it went to the US, but it was big and it was volatile. But in the end, that metal ended up coming to the US, right? Now, it did drain out over the next 4 years, but that's not the point. That point is, again, another conversation. Then what happened, and this is unprecedented. I've taken this chart back to infinity, like negative infinity, right? Okay, this is new. And this is a reflection of the metal chronically coming to the COMEX. It's not coming here for a minute. Some of it's coming to the COMEX and going out the back door. Who? Is it going to China through the COMEX? Is it going to the U.S. government through the COMEX? A little bit of tinfoil out here. Is it going in someone's basement? Is it going in Bunker Hunt Jr.'s house? The point is, this should not happen. It's supposed to go like this. I don't care if it goes up to here or down to there, but it's supposed to oscillate like this. And you know why it's supposed to oscillate like that? Because the gold in London is the same damn gold as the gold in the US. So why do we have a real gradual uptrend that's kind of getting out of hand right now? I would put it to you this way. We're repatriating our gold. Why? Are we doing it for a gold standard? Almost definitely not. Are we doing it to monetize the gold? Yes. Do we need physical gold for trade with the BRICS going forward? Yes. That's what M-Trade is. That's what BRICS is. That's what Bretton Woods 3 is. And, I've been thinking that for a while. The funny thing is, you're like, okay, everyone's talking about gold right now, right? And certainly I'm one to talk about gold, but it's also happening in silver. Let's see if I can find that chart. That's gold, right?
Yep.
All right. Let me see if I can find silver. Oh, look at that. It popped up by accident. Everyone should buy this book or get it for free or however you're getting it to them. It's really good, and I was honored to have written for it. We'll come back to that. Oh, there's silver. All right, so there's silver. So silver exhibits the same form,
Wait, is
and that
that? It looks like it's gold because it says GC on the chart.
it
Is that
does.
the um?
It does say GC. How did that happen? Well, there you go. I don't have the chart. I must have got them mixed up.
Well,
But anyway,
we'll
so
throw it in. We'll throw it in. I'll make
yeah,
a
yeah.
note of it.
I must have mixed up the charts. All right, so um, the silver and gold situation are both chronically being pulled out of Europe and to here. Now, can it go back there in a heartbeat? So this is why the weekend matters, right? If tomorrow Trump says no tariffs, just kidding, April Fools. Well, the EFP, which is the measure of the demand in the US versus London, will collapse and gold and silver will probably drop significantly. 100-day moving average for gold is where we would go, I think. Silver will get below the 200-day moving average, and then who knows what would happen. I would leave that to you as a technician. However, um, the metal's not going to transfer back to London overnight. So the answer is because of, if you read the FT or the other mainstream media sites, if because of the tariff risk, that has kept a bid under gold and silver, and that's accurate. Uh, but the buying is more than it seems, and because of that, I would say that uh, what we have is a trend that's getting exacerbated by potential news, and it seems that we that Trump has announced today that he will be doing 25% tariffs on Mexico and Canada, which should make the market freak out. Did gold and silver rally in the last hour? Anything significantly?
Um, are you talking about the last hour since we started
Only in the
talking?
last hour because he announced it at about 1:30 or 2 o'clock.
Was there a little bit of selling? Yeah, it looks like. I mean,
There
on
you
the
go.
daily charts, we have red candles now. If I'm looking at the hourly,
No, no. The hourly shows that there was selling. So there you have it.
yeah,
Whatever happened, whatever happened, the uh the marketplace,
it's yes, yeah. I mean, it's just buy the rumor, sell the news situation.
yeah,
But
exactly.
what you're saying about the technicals, I mean, we know that gold is already broken out. Gold's strong. Yeah, I mean, it could fall back below 2,800. That doesn't worry me. Silver still looks pretty good, Professor. I mean, I made a tweet about this a couple days ago. Like, if you look at the daily price action the last month, it's tested the 200-day two or three times, had a strong push the last couple days.
Right?
Um, it closed the month above 32. I mean, let me look at the price here, depending on what time you use. Hey, it's still 32.21 as we're talking. So, yes, it definitely can come back, but I don't know. I could be wrong, but maybe the tariff will come out of the market partially, but I don't think that's going to apply too much technical damage on the downside.
Um, well, that's it. I
Unless
mean, I'm going to
unless I'm
defer.
really really underestimating the situation.
I'm going to defer to you on that. I mean, um, um, speculatively speaking, I'm long silver right now. So I'm long gold and I'm long silver all the time. But speculatively speaking, I'm long silver. I was long silver and short gold a couple weeks ago. And I may have mentioned that even as far as a month ago with you. And I got my ass handed to me because it just, you know, as soon as Powell said, hey, you know what, I might not cut so much, more selling of silver came in and no one really sold gold. So I took the gold leg off. And after a week, meaning I'm no longer short gold against my long silver, after a week, I'm back to break even. So uh, the point is, the point is, I'm very comfortable. This is kind of crazy to say, but if gold does not crap out, excuse my French, because of Trump saying April Fools, which he didn't say, then silver's a buy. That's how I'm looking at it. I believe that uh, silver should outperform gold over the next 6 months, and that's the time frame I'm holding it for. And by the way, I'm long bonds against that because if I'm wrong, I think money will go to bonds. Kind of like I'm long stocks and long bonds as a hedge. My 60/40 portfolio is long silver and long bonds. So there you go. We can start looking at that now. Anyway,
Wh-
I found the silver chart. I'll send that to you in the chat,
okay.
but we can talk about whatever you want to talk about now.
Well, I want to get to one more thing because you had a chart of gold showing Fibonacci levels, and there was a from one of the investment banks. I think they had like a real serious technical comment. Do you want to touch on that at all, or was that just
Yeah,
for
let,
me?
let me bring it up, and then you can comment on it. Let me find that. Uh, hold on.
It's
Uh,
right in it's towards the top of the
no,
chat log.
I understand. I'm going to. I want to. Where is that? I'm looking for something else. Nope. All right. There's the chart. Yeah, the chat log doesn't. It doesn't. It's not easy to pull up that way. All right. So this chart should be a little bit bigger, right? Let's do this so we can use it a little bit better. All right, so here's the recent activity in gold, and I put this together about an hour ago, so it's before the market came off a little bit.
And those
All
are
right,
weekly bars, I'm guessing.
yeah, I use weekly bars, right? And here's the 100-day moving average before we started to run up, 25.80, 26.20. Okay, so while everyone is looking at that, what you're looking at is something that everyone, something I call a measured move and something that Jordan calls a measured move. And that is you get one of these rounded things, and if you break above it, the market should go, in my opinion, the market should reasonably have a target of the depth. So it's kind of like, the cup and handle concept, rounding bottom, you break it, you get a measured move higher. And it's been a rule of thumb that served me well all the way up to the election. However, although I never looked at it as a Fibonacci, it is apparently a Fibonacci thing. So let me see if I can find the quote. It's in the chat, right? It's in our
Yes.
chat. All right. The quote goes like this. Well, first of all, let me introduce it. A very large, very powerful, very influential American bullion bank, who shall remain nameless, has an institutional technician. And usually banks trot out their technician as color. They usually say, and we think gold's going to go up because something. And our technician says, because they don't really have price targets, because there's no earnings, they need technicians to help them with that. Now, but this week, in fact, hours ago, I'm sharing this with you before I'm even sharing it with subscribers. Uh, this bank's technician said the following: gold prices trading stable overnight, meaning last night, though we saw new all-time highs made on Thursday. If we see a weekly close above 27.90, that's today. If we see it's spot. If we see a weekly close above 27.90, my colleague so and so sees a move towards 28.87, 2900, which is approximately a 3% rally from current levels. Now, this is obviously a tactical trade. This is the region where the double bottom indicated a larger target around 28.90. 38.2% Fibonacci extension puts him at 28.87, as well as a psychological level of 2900. We think this will then form a strong resistance range. So we shouldn't get above 2,900 at least for a while if we get there. Now, I tried to reverse engineer his thing there, and I think I got it. He basically did a measure move. He said, let me I need to move this. He used this high. I'm telling you what I did, and you can tell me if it makes sense or not. And he used either this low, probably this low, because he said it's a double bottom, right? That's not a double bottom. That's a penetration of a double bottom. So right away, it's technically not a double bottom, but he's calling it a double bottom. And he measured this, and then he put it at 138% of that. And I came up with approximately 28.82. So he thinks this, although he's not looking at it as a measure move, he's saying this move down and rejection gives you a rally to here. What do you think of that?
It's definitely possible. I yeah, I see. And also, if there's some like the original cup and handle, there is a way because the two highs, the you had the 2011 and the 2020 highs, because they were like this, where and I can people can see on the screen, I think, where the right side was a little bit higher. So there's a couple different ways you can measure the original cup and handle, and I think one of them you get to like 2,900 for the target. Although I personally think 3,000 is a more precise slash better target. So I do think it's possible you could see 2,900. But if you think about it, Professor, I mean, just going off of today, if I pull up, I'm looking at gold here on the hourly chart. I mean, it got pretty 2860, so it was pretty close to some of those targets
Right.
that was
Well,
already
well, well
mentioned
but, that,
there.
but that's futures,
Oh, he's
right?
talking about okay, he's talking about spot.
Absolutely. He's talking about
Oh,
spot.
okay, okay. And so spot, we are so right now the spot price, I'm pulling it up, is about 2,800? Does that make sense?
Yeah, 27. That's his point. We got to settle above 27.90 in spot. That's what he's looking at. Yeah, yeah.
And I think yeah, I'm looking at if I got that right, I think we did. Looks like for most of the day we did, other than just like a little bit. But yeah, so on futures, that could bring us pretty close to that 3,000 target because right now there's about a what like a 60 or what 30 or $40 difference.
Right,
So,
right.
but I guess what I'm saying, if you look at what they're talking about, 2890, 2900, 2887. So what would that be on futures? That would be somewhere near 3,000. So then is that correlate with the cup and
I
handle
think
target of
so. Well,
3,000?
that's the funny thing. The funny thing is, if this, so just to make sure we're on the same page, yeah, the future spread is going to be higher than 2,900. So it could be closer to 3,000. The funny thing is, it shouldn't be $100, but it should be close. Okay. However, however, um, um, if this physical problem, if the US keeps taking metal from London, spot could be trading 2,900 and US futures could be trading 3,100. The point is your number could be valid without even being a stretch. You follow me?
Yeah, and you're saying the spread can rise.
Yeah, exactly. The spread could definitely rise. Why am I having a hard time? Oh, there it is. There's the cup, right? There's the handle. I see what you're saying. Yeah.
But there's also a potential if you look at it's not a perfect triangle. A lot of people have been trying this triangle on gold. It's not a perfect one. I mean, this is really like I don't want to get too in the minutia. I mean, there is a potential triangle. You've probably seen people drawing that, which gold has broken out from. That has a measured upside target of about 3,100. So that's that's what's interesting. I mean, it did today. If today did not put in like a short-term peak in the market, then
right?
we could go to 3,000 or 3,100 on futures. And also when like they're talking about, okay, well, 2,800 is in spot is going to be a peak for a while. I mean, is he talking about 3 months or 3 weeks, or even 3 days?
Well, that's the
That's what.
thing. When there you go. There's the chart that we're looking at.
Okay.
There's
Yeah.
gold spot. Um, Let me just start by answering that last question you said. He's not giving a time frame for it, and I
Because
think that's
you
the
never give both. Yeah, you never give both.
well, I haven't said his name, so let me just say this. He never give both, right? Uh, I looked at how he came up with a number and it was imperfect. And the fact that you're not putting a time frame on it is typical of a technical analyst who isn't really doing anything except measuring numbers. So 6 months from now, he could say, "See, I told you." And to say that without giving a pullback level is disingenuous. Like for example, we're looking at that little thing there. I'm like, yeah, that's my target above here. Well, where's your stop out? Where's your stop out? So it sounds to me like his implicit stop out is if we get above 2,900 and close above it, then you buy it and you stop yourself out at 2,900. But anyway, uh, I've actually lost a cup and handle. There it is. There's the this is the
Here,
handle, right?
yeah, you're looking at the handle.
This is the handle right here, right?
Or are you talking about the original one or a
The
different
original
one?
one. Should I be on a monthly?
Yeah, you should. Yeah, you
Oh,
need to go
Jesus.
back. Yeah.
Yeah, I see. I see.
So yeah, that's the handle from. Yeah,
Oh, I see. This chart doesn't. Hold on, hold on. Bear with me. I'm
it doesn't
sorry.
go back. It doesn't go back that far.
This one will. There you go. That's more like it, right? So there's your
Yeah.
cup.
So yeah,
Right. There's my original triangle, my original square saying, "Oh shit, if we get above that," and there's your handle. This was PAL, and now we're through it. So now you're saying, Jesus, that's a really nice candle, Jordan.
you mean the
That's
monthly
really
one?
good. Yeah,
Yeah.
look at that.
Well, I was just going to mention. I mean, we closed the. We closed the. It was a good monthly close and a good weekly close too.
Which brings us like let's go back to what we started doing this for. First month of the year closes on the highs, closes above the end of the year sell off due to Trump's election. After the inauguration, nothing happens, nothing in the world, and it still closes on the highs. Jesus. Event risk aside, macro discretionary is going to buy this come Monday morning. We're back to the November. Remember, this whole started with November 30th with you and I saying, of 23, mind you, of 23. You saying we get above 2000, we said above 2009, and then that'll be a good 10. Oh, well, then that's when the microdiscretionary will buy. And here we are again. Can there be any reason to not buy this? I think you need to be looking at the monthly parameters, need to be long with a 27.39 stop out. And where does that come in on the daily? Makes no sense on the daily, but that's where I'm going to put it. Comes in here, right? So
Yeah.
your
Well,
first
that's
level is
yeah.
here, and the second level is the level that I care about the most, and that's
The
this level.
100. Yeah.
Yeah, this is here it is. Not because I'm a fan of 100-day moving averages. I saw this quite clearly. I saw this. Where's that? I should be able to draw on this. All right. Well, I guess I can. So this here, China bought this. This is China. This is China. I don't know who's in here. Maybe they didn't buy here, but people stopped selling it. The 100-day moving average is a reason to buy. And as a bull, I actually wanted to get back to the 100-day moving average. A return to trend would not be a bad thing. Um, I, I welcome bad news. So my first level is long story short, 27.39 and then 26.60. And that's a 6 month position. It doesn't come out so easily on silver, but that's what I would look at. I think it's pretty
Yeah,
good.
good segue. Let's finish up and talk about silver, and you could throw up the monthly, and we could talk about levels and
Sure.
perhaps what the macro discretionary guys may or may not be doing.
Oh,
So
let me get
let's
rid of my one.
start with a monthly for silver.
All right. What do I have there? I think that's my 50-day moving average. No, that's
Or
my
is that
100-day.
that's like a 50 month, the red one.
Yeah, yeah, yeah. It's ridiculous. Let me just hide them.
Well, that's a good yeah, you can hide it, but
I'll put it up. What did you want?
oh, but I like using the 40 month, like throw up the 40 month. It's like pretty that does a really good job of showing major levels.
All right, that's
Like you can
50.
see, look at that.
I'll change it
Yeah,
for you.
no,
I'll change it for you. 40 month. Oh, it's almost the same thing. But yeah, I can see what you're talking about.
the 50
That's
is a little better. Is this silver is this a spot that you have, right?
yes, I have spot.
Okay. It's a little different from futures.
Well, you want me to put futures up so you're working with your own
Yeah, is that
with your own
possible?
animal?
Let's
Sure, I
take a
could do
look at
that.
the futures.
There you go.
Okay, yeah. So let's look at I think we talked about this a month or two ago, probably in December. So if you look at the monthly, you can see 32. I mean, look at the ticks in the last 6 or 7 months or so, and then you have it looks like there's stiff resistance, right? I would put it what, maybe 33, maybe. Yeah, those two candles right there. Yeah.
Yeah, I look at the top of this candle. I'd say congestion between here and here, and then who knows what's in here. Probably more
So
selling. Probably more
so
selling.
yeah, so what needs to happen for the macro discretionary guys to buy silver?
Oh, yeah, um, that's a harder play because silver has become a value play for macro discretionary. So macro discretionary already has it since November of 23. Macro discretionary already has it in their agenda that anytime gold makes a new monthly close high, goes through some significant thing that they have, we're going to buy it the next day. Discretionary, they're going to buy it the next day, the next week, the next month. They're going to buy on dips. They're not going to necessarily buy strength. Silver's been a harder call. And silver's been a harder call because so many of the macro discretionary guys were selling silver while they were buying gold in an attempt to play the Fed tightening. If the Fed tightened or if they didn't ease, they want to own gold because that's what the central banks are buying. And they were saying, well, silver will give me some hedge against gold because of its industrial use. Not to mention that silver futures you can offset some of your margin requirements in gold. So it's a beautiful little way to reduce your margin requirements, which increases your return on capital. And it's been a nice trade. Now, so a portion of macro discretionary is selling silver against gold. A portion of your bullion banks is selling silver to buy gold. But then it's discretionary. There's a portion of the macro discretionary boys who say, it's too cheap, I'm going to buy it. And that's what they're doing. And that's what happened in these last few days. And the reason I bring it up now is because the, sorry to torture everyone's eyes here, but on the daily, you care about these in silver right now. So this is the 200-day moving average. I'm sorry, this is the 100-day moving average. And here's the 200-day, and we could not get above it. And we were staying below it. And now we just kind of like rejected the 200 finally, rejected the 100. So now you have a combination of macro guys that are looking to buy this. Okay, because across two important moving averages, and I don't know that the 50-day average matters to them. Yeah, it's in there, right? So now you've got these moving averages crossed. I think that macro discretionary is looking at precious metals to be bought. And technically, gold looks better, so they will buy gold. However, if it gets above silver, gets above here, you're going to attract some
That
buying,
that's
and that's the
that's what
level
I'm
usually.
thinking. If you get a clear daily close above 33, that will probably bring in more buying.
Right. On the weekly, bringing it to the weekly, let's just say you're a good old fashioned, technician. A good old fashioned technician is going to say, no matter where you draw this line, you should be buying silver. And the next line that matters isn't a line, it's a range. I'll show you what I mean. This is just how I do it. And what did you say? 3,200 to 33, 3,280 to 33?
Well, yeah, on the weekly 3200 has been
All right.
resistance.
All right. So there you go. There's I create what I call dead zones, right? So there's a level we have to settle through to negate this. And then I say, what the hell's going on here? And so this whole area here, for me, is a dead zone. For macro discretionary, it's probably also a dead zone. We get above 33, 33, then I don't think that this high here is going to hold it back. That's what I think.
Well, yeah, looking at or just I'm remembering other analysis I did for silver. 37.38 is also a target. So if you think it's going to take out 35, then that's where it would go next. But for
Should I go to a
silver
month?
to
30, $37? Is that what you're saying?
yeah, I'm saying after 35, like 37, 38, there's a little resistance in there. I think you might have to go back to 50 years.
Oh yeah, I used to model this.
Yeah.
See that there? That's something I put up. This is when JP Morgan made the announcement and just got silver to crap out. So I'm gonna leave that there until they go bankrupt. 37 or 38? There's
Yeah.
37, there's 37.58 to give you an
Yeah,
idea. So
that's
30, so yeah, that makes sense. That makes sense. You're like,
so
so you're
yeah, my point is if 35 to 37, that's really the area that silver needs to bust through that. If it busts, that's really the last resistance on the way to 50 in terms of
right.
monthly and quarterly resistance.
I see what you're saying. So if I were to just take this line and just draw it back to here and just
Yeah.
go that and then say go here, and even though that line's pretty, just leave it. Just say, look, we get above here, we go to here. We get above here, we have to get through here. Do you think we'll run above this level to that level, or do you think we'll work it?
Like on the first try, no, I think we'd probably work it. I mean, just like 32, that's what the market's dealing with now.
Right, right. Okay. Right.
And,
Yeah,
and I think I think
there's a lot of
unless
buys. There will be a lot of sell. The first time up, there will be
yeah.
a lot of selling, but it will be fresh selling. So
Yeah, 30, yeah, 35, because you can see on the wick, uh, 3 months ago, or it must have been October, right? When we traded up to 35. I mean, it was sold hard after that. Yeah,
yeah,
that month.
that month, yeah, that was October. Yep, that was beginning middle of October. In fact, doesn't this look like just a nice little channel? You know.
Yeah, it could be.
Oh, I will say this about silver, just to give people something that's not technical about it. Uh, UBS recently, about a month ago, and they reiterated a week ago, they said, we're long gold. We recommend staying long gold, and we're not backing off. Silver, they said, uh, we are buyers of silver for our own account and for our clients if it gets down to 29 or 28 in that area. And the reason for it is, well, they're not going to say too much about it except to say they see physical demand down there and they're going to be recommending and doing the following. They'll be selling puts and put spreads. So that's how they're going to get bullish. So I think I think when gold gets overbought, silver goes down to 28. You know what I mean? And that's when we pile in. Hopefully not while I'm long, but that's it.
Yeah,
Should I
I
stop
mean,
sharing?
yeah, that's fine. It got down to its lowest close on futures was 29.24. So 29 is really strong monthly support.
Right,
And I mean, really good candle, really good monthly candle for silver. So 29 on a monthly basis is that's really strong support. That's now been held multiple times in the last 6 months
right.
as far as monthly closes. So yeah, I see. Yeah, I think you were saying if it gets down to 28. So I mean, yeah, if that happened,
No, but what they said was 28 to 29. So hear me out. I'm talking for the bank now. Their level is 29. They're giving themselves some slippage because they have clients. Like they're buying at 29. They'll tell their clients to buy it 29. And look, I think they're long already and they'll add to a position. That's all I'm saying. That's what I'm going to say. So I think their level is consistent with your level. The funny thing is, about a month before that, their level was 28 to 27. So they're raising it. Their physical demand is there. There's one other chart that I'd like to show you if you don't mind.
sure.
It's it's a rectangle. It's a rectangular formation. See if I can find it. I think you're familiar. I think you've seen this before. There it is. See that rectangle?
Oh,
There
yeah.
you go. No, no, but that's your book. I think it's really cool to see something physical like that. Gold and silver, the greatest bull market has begun. Wow, how good will this book be 50 years from now if you're right about everything?
Yeah, it could be a classic, or it could
Did you
be
update the
trading for
60/40?
trading for 10 cents on Amazon or selling for
I know.
10 cents. Uh,
I know you updated the 60/40 portfolio.
yeah, so I like the problem I had with it, which I realized like 3 weeks ago or so,
Wait, but
was
it's a good wait, hold on. It's a good problem, right?
yes, it was a good problem because well, the problem I was having is I was I had the data, I was calculating myself, 60%, data times
Yeah,
60% or stocks times 60% plus
right,
bonds times 40%, but you have to rebalance it every year. And so that's what I mean the computers
right,
and institutions that have that. And so I didn't rebalance it. And so what that means is the last, 5, 2, 3 years or so, we're really looking at like a 65/30 or a 70, a 70/30 rather than a 60/40 because stocks that the problem
right,
is that over time, based on the performance, it gets out of whack. And
right,
I was looking at it even during, I think even during the Great Depression, it was way in favor of bonds, because stocks just totally crapped out. I mean, it was like
right,
55/45 at one point.
right,
Um, but that's the issue. And what I did not realize is you have to every year you have to rebalance and adjust the pie
right,
back. So the pie is 60% stocks, 40% bonds. So I had a buddy who helped me with that, and yeah, it looks better because it's like a now gold against the 60/40 is trading in a 10-year, almost a perfect base, and it did have a little bit of a breakout. I think 2 or 3 months ago. Now it's come back down.
right,
Um, I did not have time to update the data, before we're talking today, but I'll
right,
update it later today. But yeah, we're getting really close. But I think the key thing is we really need gold against the S&P. That's got to break above 0.50. I think it's about 0.47 right now because you
right,
really need you need that to happen. You can't just have gold completely, bonds being so shitty that the gold against the 60/40 is surging just on the
right,
back of bonds being garbage. Like it's
right,
really for a real breakout and a real huge move, it's got to be outperforming both. So it
right,
has to start outperforming the stock market at some point. And maybe we were talking about it, but maybe this year will be the year it finally does.
right, right, right. Right, I see what you're saying. So if you don't adjust it every year, you're actually, as time goes on, you're really comparing gold to more and more of the stock market. And that makes it harder to look like it's doing okay. But by the same token, you're saying that. hey, if we break out because bonds are shitty, not because gold is strong, then although it's technically a breakout, it's certainly not something you'd want to pile too much into.
Well, it's like if you it's kind of like breadth. Like breadth when you're looking at
Yeah.
I mean, you're looking at 10 stocks, and for the market to be strongest, you really want it to be, you want all 10 stocks to be
You
performing
want it to
well.
broaden. You want
Right.
it to
And
broaden.
so, I
Right.
mean, it's a super simple concept in the 60/40 case because we're only looking at gold against stocks, gold against bonds.
Right.
But
Right.
it's really going to be strongest and really explode when it can outperform stocks. I mean, it's so far ahead of bonds that it doesn't matter if that pulls back a little bit. That's already so far in breakout territory that
Right.
it once it outperforms stocks, then then it's it's in a secular uptrend against both, and that's when it's most powerful. And by the way, this is why this is the difference between or why the current or fledgling secular bull in precious metals, why it's going to be more like the 70s. Because in the 70s, you had bonds and stocks were both in secular bears. Like if you look at the 2000s, bonds were still in a secular bull.
Right.
And even in the 1930s, bonds were still, I mean, I know we're going way back, but even in the 1930s, bonds were still in a secular bull.
Right.
And so that's what like this time what we're setting up for is eventually, I mean, bonds are already in a secular bull or secular bear. And so when
Right.
stocks go into a secular bear, then, I mean, we've talked about it before, but then you have gold and hard assets are the only thing that's in a secular
There's
bull.
nothing. There's no place to hide. We're
Yeah,
seeing that.
yeah, exactly.
Exactly.
Yeah,
Exactly. I mean, if you think about like, it's like uh for the last, especially for the last, say, 15 years, in the QE era, the whole bonds and stocks rotation thing has been really big, right? So uh, a hedge for stocks is bonds, a hedge for stocks and bonds. And so people are buying bonds and stocks, and the QE era is dragging them both higher. So where's room for gold to compete with that? It ends up having to be priced like a risk on asset. But the QE era is over. We may get QE again, but it won't be QE to make things stop, to go up. It'll make things to stop going down. I'm referring to yield curve
yeah.
control.
And
So
and so what we're saying, yeah, QE, and you could, go back and forth, but bonds crapped out after COVID. I mean,
yep,
I
right,
in the book I talk about my secular indicator, which is the 80-month moving average adjusted for inflation. They've
right,
crapped out. So, but those people, like retirees, big institutions, yes, they're moving out of bonds. They're probably moving a tiny bit into gold. I mean, because you know about that back in the day, you know,
right,
uh, how the old timers used to work. But all these big institutions, pension funds, they've moved probably most of their money into stocks because they can get 4% or 5%
yeah,
dividend. Like they're using dividend blue chip stocks to replace that lost income on bonds. But what
right,
happens when gold starts outperforming stocks? I mean,
right,
it's gonna go vertical. I'm not saying it's gonna happen in like a month or even a year, but
right.
when you have a major shift of, it doesn't have to be all the capital, but just some more capital from stocks starts moving into gold because you're going into recession or a downturn. Gold is going to go vertical.
Right. Every dollar that comes out of stocks, uh, uh, 90% of it used to go into bonds, and 10 cents, 5 cents used to go into cash, and 5 cents used to go into gold. Now it's going to be every dollar that comes out of stocks, 70 cents is going to go into bonds, and 30 cents is going to go into stocks. I mean, into gold. And that's not going to be enough to stop bonds from dropping. Hear me out, because I want to give you a scenario from a completely different discipline. That's not my own scenario. This is a scenario implicitly drawn up by, believe it or not, Zoltan Pozar. When in 2022, 23, he made a comment that was, I thought, important. He said the Fed put, the we're going to support the stock market through hell or high water. He said the Fed put is no longer keeping stocks up. Not that they won't go up. But he said the Fed put has retreated from stocks, if you think about the extra pyramid, has gone from stocks to bonds. So now they put the Fed put at bonds. Now bonds have performed shittily, don't get me wrong, but there's a put there in bonds now, and that put is in the form of whether it was Yellen getting someone to buy our bonds or QT being slowed down. Bonds could be a lot worse. Now, to extrapolate, if the put is no longer preventing stocks from going down, and it is preventing bonds from going down because it goes, if you're not going to prevent the stocks, you pull back the troops to bonds. If you're not going to prevent the bonds from going down, you pull back to currency. Well, they're going to stop at bonds. They're not going to have to defend the currency. They'll need to weaken the currency. But this is the situation. When stocks start to turn, they're not going to support them. They're going to make sure that bonds don't crap out again like COVID. But don't get me wrong, bonds will crap out unless there's a fiscal miracle. And so they'll be spending all their money, the plunge protection team, on protecting bonds. And that's where I think you're going to see what you see. So stocks will be down, bonds will be unchanged, and gold will be up. And that's where we see the Dow and gold both hit 3,000 or 4,000 or something like that. Anyway, I believe there's a scenario that's not too far-fetched, and that is stocks turn lower, bonds don't catch the bid that they used to catch, and that money goes somewhere else. And that somewhere else is gold. We're seeing it now.
Yeah. And another thing I want to mention, because if you think about secular inflation periods,
Right,
secular bear market in bonds, we've only had one in the last 100 years. Like there was one, I think, from 1900 to 1920, or
right,
1906 to 1920. But
right.
so there's only been, like, we're only going into the second secular bear in bonds, and
That's
only the
right.
second period of secular inflation. And the stock market does not crash when bonds are in a secular bear. And the reason is, if you look at all the crashes, 29, 2008,
Oh, they're
2000,
deflationary. They're
2000,
deflation. Right, right,
1987. They're all during periods when bonds have been in a secular bull. And why is that? Because there is a conventional alternative to
right,
stocks.
right,
So because people, they could sell out of stocks, and they're like, oh, I'll just put my money in bonds are doing well, I'm going to get my 3 or 5, whatever. I could sell and put my money in bonds. But in a secular inflation, you don't have real crashes in the stock. Like, I'm not talking about like a 20% or just some
right.
bear market.
You have more
You
of a
don't.
stagnation in
Yes,
stocks.
yes, you don't have crashes because there's
Right,
not that bond alternative.
right.
Um, and so people would say 1974, 70, was it 73, 74? But if you
Yeah,
look at that, like, that was really, I mean, I looked at that and it was really like, it took a while for that to really crap out. Like the first, like most of that bear, it started out kind of going sideways lower. And it wasn't until like the last like 4 months or so where it just crapped out and it plunged at the end. So
yeah,
that followed a different pattern, because most bear markets you get the plunge in the middle, but that one was at the very end. So most of that bear market was really not that bad until the
right.
last 3 or 4 months.
The capitulation was the worst part of that bear market.
Yeah,
That's
yeah,
right.
there you go.
That's right. Um, so I guess what we're hoping for here is, in terms of gold numbers, we're hoping that it's 1976, in a sense that inflation bottomed in 75, 76, bicentennial was over, and then it took off again. And I think the case for that is being slowly made because we didn't talk about the FOMC, and I want to mention this. There's a lot of soup that comes out of that, but there is, from the inflation point of view, there is one incontrovertible thing that came out of it. He expects inflation to stay higher. He's tolerating it, meaning he's not going to ease anymore. He will, but he's not going to hike. He's accepting inflation at a higher level without saying he's raising his target. Percent for the next 3 years, I think. And I think unless housing cracks really hard, inflation's not going to crack at all. And we're setting up for, I'm talking about 77 in terms of inflation, but we're setting up for 74, 75 stocks. Stocks start to roll over, roll over, roll over before they dump. So we could have a situation like that without bonds being of any help at all. Anyway, I hope you're right.
Yeah, and I think just one thing with the Fed and interest rates, they probably don't like they have the bullets in the gun, so they can just wait. If we get a little, well, like if we're going to have a recession, then they know they can just resume lowering rates because
Right.
the recession will bring down inflation just a little bit, but like you're saying, it's not going to bring it that much lower.
They can't.
But if you have a yeah, unless housing craps out big time. But if you
Right.
have a recession, they're going to be cutting rates, and Trump will say, "I'm vindicated." You should have,
Right.
they should have
The,
been
the,
cutting rates before,
right. The
and
patient
they'll
has
they'll
an right. The patient has an addiction to easy money, right? And you're trying to wean the patient off of easy money. And if it gets to be too much, what are you going to give them? Easy money, right? So to put it in less of an analogy and more of a reality, Trump needs to get his stuff done in the first 100 to 300 days. If he does not, this is like completely true. If he does not, then he will need a weaker dollar and he will lean on Powell to do it. And either Powell's going to do it or he's not. And if he doesn't do it, he's gone in a year anyway. So to put a fine point about a policy, if Trump's policies don't work or if he doesn't get them done in the first 200 days, then he's going to need a weaker dollar, which means if inflation is not at 1% in 200 days, it will be at 4% in 500 days. And that's bullish for gold. And to your point, it might not be bearish for stocks, but it ain't going to help bonds. That's for sure. That's it. I agree with you.
Yep. All right, Professor. Before I let you go, why don't you tell all the listeners out there how they can
Sure.
subscribe to Gold Fix?
Sure. Subscribe to Jordan's stuff to the Daily Gold first. And then after you do that, you go to Goldfix and you go to VBL Goldfix, Victor Boy Larry Goldfix, or Goldfix Substack, and you sign up. We provide daily reports. We provide institutional reports. We provide actual bank reports, and we give insights into markets like this. But more on a fundamental side and on a flow trading side, covering precious metals, inflation, monetary policy, macroeconomics, and geopolitics. So we'd love to have you. That's it.
All right. Thanks, Professor. Great job. And we'll see how everything develops. And I guess we'll talk in another month.
Right. Hey, I'm sorry, I didn't mention your attire. Very nice shirt today. I think you're getting closer to wearing the suit, aren't you? You're really getting
Yeah, we
close.
are. Yeah, we're getting.
I
Yeah,
think you're
got to
taking.
get gold up to 3,000. Yeah.
Does it have to be futures to be 3,000?
Yeah, futures is what I follow. So,
Okay, well, guess what? It could happen without gold breaking 2,900 if this tariff thing goes through. If Trump comes out and says 90% tariffs, gold goes to 3,500
yeah.
without London moving at all. So let's see what happens. I look forward to it.
All right.
Thanks, Jordan.
Thanks.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.